Have you ever been lying in bed on a Sunday night thinking about the week ahead and wondering how long you'll have to keep doing this? Not just the next week or the next month, but the next 20, maybe 30 years. At some point, many people start asking the same question. What would it take to earn money without trading my time every single day? Maybe you've heard people talk about passive income. Maybe you've seen screenshots online showing dividend payments hitting someone's account, and you might have wondered, is that actually real or is there some trick behind it? Today, we're going to break down one simple question. What does it actually take to earn $1,000 per month from dividends? Because the math behind it is simple, but the mindset required to reach it is where most people struggle. The reality behind dividend income. First, let's clarify what dividends are. When you buy shares in a company, you become a partial owner of that business. Some companies choose to share part of their profits with shareholders. Those payments are called dividends. Think of it like owning a small piece of a company that pays you regularly just for holding the shares. But here's the first misconception many beginners have. They assume dividend investing is some secret strategy used only by wealthy investors or retirees with millions saved. In reality, it's much simpler than that. However, it does require three things most people underestimate: capital, time, and consistency. There is no shortcut around those. Why dividend yield matters. To understand how much money you need, you first need to understand something called dividend yield. Dividend yield is simply the percentage of your investment that is paid back to you each year in dividends. For example, if you invest $10,000 in a stock with a 3% dividend yield, you'll receive about $300 per year. That's $25 per month. Now, here's where beginners often make their first big mistake. They search for the highest dividend yield possible. Maybe they find a stock paying 9% or even 12%. That sounds amazing, right? But extremely high yields often exist for a reason. Sometimes the company is struggling. Sometimes the stock price dropped dramatically. And sometimes the dividend simply isn't sustainable. So experienced dividend investors often focus on more stable yields, typically somewhere between 2 to 5%. Not exciting, but much more reliable. The math behind $1,000 per month. Let's break down the numbers. If your goal is $1,000 per month, that equals $12,000 per year in dividend income. Now, let's see what that requires depending on the dividend yield. At a 3% dividend yield, you would need roughly $400,000 invested, because 3% of $400,000 equals about $12,000 annually. For many people, hearing that number feels discouraging. But remember something important. This isn't something most investors reach overnight. It's usually built gradually over many years. The power of dividend growth. Another important detail most beginners miss is that many dividend-paying companies increase their payouts over time. Some businesses have raised their payouts every single year for decades. Imagine receiving a small raise every year without negotiating for it. That's the advantage of strong dividend-paying companies. Your income can slowly grow without you adding new money. A different strategy: growth first. Not every investor focuses entirely on dividends. Some people prioritize growth investments early on. These companies may pay very small dividends or none at all, but they grow faster in value. Later, investors can sell small portions of their portfolio to generate income. This approach can sometimes build wealth faster in the early stages, but it requires a different mindset. Instead of income coming automatically, you periodically withdraw from your portfolio. Both strategies can work. It simply depends on what fits your goals. The balanced approach. Many investors choose a middle ground. They invest in broad market funds that provide both moderate dividends and long-term growth. These funds might yield around 1.5 to 2%. That means you would need closer to $700,000 to $800,000 invested to produce $1,000 per month purely from dividends. But over time, the value of the investments may grow significantly as well. Higher yield options and higher risk. Some investments offer higher dividend yields. For example, certain utility companies, real estate investment trusts, REITs, or specific high-dividend stocks. These might produce yields around 4 to 6%. At those levels, the capital drops to around $200,000 to $300,000. But higher yield usually means higher risk. Industries change, markets fluctuate, and sometimes companies reduce or eliminate their dividend. That's why diversification is so important. The real secret: reinvesting dividend. Here's the part that quietly builds wealth over time: reinvesting dividends. Instead of spending the income immediately, many investors use those dividends to buy more shares. Those new shares then produce additional dividends, which buy even more shares. Over time, this process compounds. It's slow in the beginning, but after many years, the growth can be surprisingly powerful. A simple example. Imagine someone starts investing with $50,000. They invest in assets paying around 3% dividends. That produces roughly $1,500 per year. Not life-changing, but if those dividends are reinvested and new contributions are added regularly, the portfolio continues growing. After enough years of consistency, the income becomes meaningful, not because of luck, but because of time and compounding. The psychological shift. Something interesting happens when people begin building passive income. It's not that they suddenly stop working, it's that their relationship with work changes. They start making decisions differently. Career choices feel less pressured. Opportunities become easier to explore because part of their income no longer depends entirely on their job. That freedom, however small at first, is what motivates many investors to keep going. One final thought. Generating $1,000 per month in dividends is not a secret formula. There's no hidden trick. It's simply the result of consistent investing, patience, and letting time do the heavy lifting. The biggest mistake people make is waiting for the perfect time to start. But every long-term investor begins the same way, with the first investment. Years later, that decision often becomes the moment that changed everything. If this helped you see money differently, subscribe for more deep dives into the psychology and math of building real wealth. I'll see you in the next one.